Welcome to Wealth Informed, the podcast that makes finance and investing simple, clear, and accessible to everyone. We are your hosts, Philip and Rajshekar, Phil and Raj for short, and between us, we have years of experience in finance and accounting. But here's the thing, we're not here to drown you in jargons or textbook definitions. Our goal is to break down complex financial concepts into bite sized, easy to understand conversations that empower you to make informed decisions. Got a quest? Want to be part of the discussion? Drop us a message at hello@wealthinformed.com. So let's be wealth informed.
Before we dive in, a quick note. We are learners and observers of finance just like you, but one step deeper so that you don't have to burn the midnight oil. Our content is designed to simplify financial concepts, not provide specific investment advice. Our goal is to help you grasp the fundamentals of investing so you can make confident financial decisions. And hey, we will also explore a bit of the psychology behind investing because money isn't just about numbers, it is about the mindset too. Now, with that out of the way, let's get into today's episode. I'm Raj, and today I'm being invited to learn about mutual funds. Honestly, like many, I'm skeptical about mutual fund investments, especially whenever we hear the words mutual funds, our brain goes, mutual fund investments are subject to market risk. Please read the offer documents carefully before investing. So, Phil, what's the deal with mutual funds? What are its big risks?
Great questions, Raj. Let's break them one by one. First, what are mutual funds? The simplest definition is mutual funds are a trust that collects and pools money of like minded investors to purchase or acquire financial instruments such as stocks, bond, gold, with an objective to retain the asset for an extended period of time and benefit from market movements. Did you get any of that?
What?
Imagine you as a kid, which you still are, and you want a box of chocolates that cost around 1,000 rupees. But you don't have enough money or feel it's way too expensive for just one person. So you gather some friends to pool in the money together, buy the chocolates, then share them based on how much each person contributed.
So, I understand till the pooling of money, but how is it invested?
After pooling the money, mutual fund managers, who are financial experts, invest the funds in various financial assets based on the nature of the fund and the market conditions.
Alright, so the experts collect and invest money on behalf of the investors?
Yes, exactly.
Hmm, what are the big risks?
Every investment comes with risks.
No, bank fixed deposits, real estate, gold are safe investments. They only appreciate.
Not actually. They do have risks. For example, bank FDs. What if the bank don't pay back? It's called credit risk. Real estate prices fall due to poor quality construction. What if the government starts offloading its gold reserves? Gold prices plummet.
Oh my god, so nothing is safe? Like I can invest and just watch it grow?
Realistically, no. However, risk can be divided based on levels high, medium, and low risk.
So I choose the low risk investments and build wealth.
You can do that, but low risk equals low return. And with the current inflation rates, your savings would end up having less value than what you actually saved.
Then how do I beat inflation and stay afloat?
That's where the diversification comes into play. Mutual funds help you diversify your investment in different assets so that your investments grow over time.
Aren't mutual funds a very new thing? How old are they?
Believe it or not, mutual funds have a very rich history. The concept dates back to 1774 in the Netherlands. A Dutch merchant, Adriaan van Ketwijk, created an early investment trust to pool money for diversified investments. He even used the motto, "Andregat maakt macht," meaning unity creates strength. Pretty neat, right?
Interesting. That's old, like ancient. I can roll with that.
But the modern version we know today started in the US in 1924 with the Massachusetts Investors Trust, a fund that allowed everyday people to invest in a professionally managed, diversified portfolio. Fun fact, the same fund is still active and recently celebrated its 100 years. Did you know an investment of $1,000 in 1924, when it was established, would have grown to $14 million, assuming an average annual return of approximately 10%, which aligns with the fund's performance over the past decade?
That's a fascinating journey. But what about India? I haven't heard anything about its history other than that rap risk disclaimer.
That's really engraved in our minds, isn't it, Raj? India's mutual fund story began in 1963 with the Unit Trust of India. Its first scheme was launched a year later in 1964, and it played a significant role in democratizing investment for millions of Indian households. Imagine getting a gourmet taste of high finance at a price that won't break the bank.
So while our grandparents were busy making our parents, early investors were busy growing their money?
Not everyone has their minds in their gutter like you. It opened doors for those with savings to join the investment world. And over the decades, the markets evolved further, bringing in more players and making mutual funds more accessible.
Now, I have heard something about mutual funds being the ultimate consumer product. What's that all about?
Mutual funds are called the ultimate consumer product because they are incredibly user friendly and accessible for everyone, from complete beginners to seasoned investors. Think of them as a subscription service for your money. Instead of spending hours analyzing individual stock, you invest in a mutual fund and let financial experts do the heavy lifting for you. It's simple, customizable, and tailored to fit your financial appetite.
So, in a way, mutual funds are like the Netflix of investing, easy, engaging, and with just a click, you watching your money work for you.
Exactly. They remove much of the complexity surrounding equity and debt investments and provide a straightforward and convenient path to financial growth. For someone like you who is a bit wary about direct stock market roller coasters, mutual fund offers a controlled and diversified way to dip your toes into investing.
All right, Phil, I'm starting to see the light. I still might be skeptical about equity investments, but mutual funds definitely sounds like a manageable way to get into the market without all the drama.
That's the spirit, Raj. Remember, investing is all about making informed decision one step at a time. With mutual funds, you get a diversified exposure, professional management, and a product that's designed to be as accessible as your favorite app.
Wait a minute, but how do I start investing in mutual funds?
There are three major ways to invest in mutual funds. The physical way, where one can invest in mutual funds by submitting a duly filled KYC application form along with a check or a bank draft at the mutual fund company's branch office or a designated investor service center, such as bank branches or registrars and transfer agents of the respective mutual fund company. You could do it online through the respective mutual fund company's website. And third, where members can use their demat account to purchase mutual fund units. We have added links for this in the description.
Which of the above methods help me track all investments in one place?
That would be the option using the demat account. This helps you invest in different mutual fund companies without filing the lengthy KYC forms each and every time.
Where do I log in to use my Demat account to buy all these units?
There are a number of platforms like Zerodha, Grow, Upstocks, Angel One, etc., which provide simple and low cost options to create demat accounts.
Thanks for breaking it down, Phil. I'm off to explore some apps and maybe eat some cake to celebrate my newfound financial curiosity.
That's a wrap for today's episode of Wealth Informed. Until next time, keep questioning, keep moving, and most importantly, keep your money working for you.
For our next episode, we will be dealing with the major asset classes, the risks allied to them, and other bonus concepts which will help you make sound financial decisions. Please subscribe to our podcast to get notified about each release and share it with your friends who ask many mutual fund related questions, like I do. Have a great time and see you soon. Stay tuned for more informative financial content.